Good evening, participants. It is our pleasure to welcome to the first webinar in this new fiscal year 2025 on Fixed Income Market Insight by UTI Mutual Fund. I'm your host for today, Sonal Mittal. I'm part of products team at UTI Mutual Fund. As you know, last month, March 2024 was quite eventful. We had data and update releases on central and state government borrowings, calendar, T-bill auction calendar, inflation print, trade deficits, to name a few. We saw liquidity deficit in the first half of the month following advance tax payments, which was followed by the liquidity surplus situations towards the end of the month. Also, we had RBI monetary policy, which concluded last Friday, where MPC maintained status quo on the policy rate and the stance. To discuss more and to share the insights and perspective on the bond market updates, we have with us our Head of Fixed Income, Mr. Anurag Mittal. Welcome, Anurag. Post remarks from Anurag, we will take up question and answers. Please note you can post your questions on the link provided anytime during the webinar to make the most of this opportunity. Without further ado, I will now hand over to Anurag. Thank you, and let's have an insightful session. Over to you, Anurag.
Thanks, Sonal, and good day, everyone, and welcome to the UTI Fixed Income webinar for the month of April. So like Sonal alluded, it was a very eventful month. It started with the FOMC, which concluded in March, where market participants were keenly awaiting how the Federal Reserve is assessing the growth inflation dynamic, which should set the tone for other central banks across the world and for dollar as well. We had very interesting updates on some of the high frequency growth as well as inflation indicators. And of course, in the first week of April, we had the RBI policy as well, which we'll be taking you through. So we'll start with the global trends and how they are looking like, and then we will move on to the domestic sector. Broadly, if you would recall, and if you allude to the left-hand side of the slide, this depicts the manufacturing PMI and services PMI. So as we can see during 2023, the services PMI kind of topped out somewhere in mid of 2023, as well as manufacturing PMI, which were in a downward spiral since the end 2022. And it was widely expected as we started the year that probably both will remain muted, and the services spending, which had picked up in 2022-23, had run its course as consumers had largely rotated from goods to services, and probably the global economy will continue to be slightly in the downwards trajectory. But as we can see from the slides, the global business confidence is improving, the supply chains are normalizing, and as a result of that, your corporate profitability continues to be quite strong, and hence we can see the manufacturing PMI picking up in the last 3 months. If you look at the services as well, the wage growth has been quite stable. The labor market across the world has been quite stable so far, and we are also seeing pickup in services PMI. So while we do expect that probably it's still too early to say that this is decisive, and we will continue to see pick up in both manufacturing and services. But nevertheless, compared to where we started the year, we do believe that things have stabilized both on manufacturing and services, and probably the growth assessments which central banks made at the beginning of the year, they may have to revise it slightly higher. It also has a bearing on the reaction function when it comes to the monetary policy. That also changes the amount of rate cuts that they will probably need going ahead to boost growth, because growth is already quite stable. Moving ahead, if you look at the other side of the dynamic, which is inflation, the commodity indices as well. So if you look at on the left hand side, the Bloomberg Commodity Index denominated in dollars, that had started to slow down in 2023 and had remained at a flat level. It was expected probably in 2024 beginning that as global economic activity slows down, even the commodities will continue to be on the downward trend. But as we can see from the chart, they have been quite flat as improving consumer demand has led to stability in commodity prices. Although I would say it's slightly a mix of two halves, because where you have a couple of commodities like oil, nickel, probably trading quite high. Whereas if you look at food prices, which is on the right-hand side of the chart, being quite stable. So yes, some of the industrial commodities are going up, especially gold, if we would recall. But many commodities, continue to be quite stable. What will be quite important for inflation, especially for India, also going ahead, is one, how oil prices evolve, and secondly, how monsoon evolves for us, and that will be a key monitorable for food as well as other commodity inflation for us. Moving on, if we look at, again on the inflationary, especially in the advanced economies, while inflation has come down quite meaningfully from the peak levels that we saw in 2022, but it still remains above target levels. And hence, like we alluded in the first slide, given that growth is still proving to be quite resilient, given that inflation is still continuing to be quite persistent, central banks may cut from current levels, because even if we consider current inflation levels, rates can be called a bit restrictive, but they are still not expected to go back to pre-COVID levels till central banks see inflation decisively moving towards their targets, which is proving to be quite elusive, that given that commodity prices have stabilized, given that growth indicators are also looking quite well balanced. If you look at the 10-year sovereign yield movement across key economies, so if we look at the trajectory between December to February, yields were going upwards. If we look at, for example, the US 10-year yields were going ahead from 388 to 4.25 between December to February, as the bond market was also anticipating lower rate cuts from the Federal Reserve. Mind you, when we started the year, the bond market, as indicated by the swap futures, was pricing in about 150 basis of rate cuts. But as the high frequency growth indicators continued to surprise on the upside, like retail sales, auto sales, other housing indicators as well, especially the labor market, the probability of 150 basis rate cut, which was there in the beginning of the year, started to go down. And hence, the March FOMC was quite a key event for bond yields across the world, because market participants were awaiting that how Federal Reserve makes sense of it. And the FOMC press conference, as well as the language, was quite comfortable. Mind you, in December policy as well, the FOMC had indicated 3 rate cuts in 2024 that they continue to indicate in the March policy as well. And they continue to treat that probably inflation is going along their expected line. So while inflation has not gone back to the target levels, it's still going along the expected lines, which can still lead to some amount of rate cuts in 2024 as well. And that gave a relief to the bond market for most of the world. As we can see, for most of the advanced economies, bond yields fell down. Indonesia and Brazil were some exceptions there, but that was largely due to idiosyncratic factors and nothing related to global monetary policy. This is, the right-hand side, we're talking about the market implied policy rate forecast. So as we can see, in the beginning of the year, the swap market was pricing in at one point of time even 175 basis rate cut, and as we can see right now, market is now even pricing in about 75 basis. The whole easy monetary policy expectation which was started had come down. The reason being, if you look at on the left hand side, which is the US Financial Conditions Index. So as we can see, this index was negative in October, which is when the financial conditions were tight. But as the year has progressed since October last year, when the December policy, when Federal Reserve indicated their comfort with inflation and indicated that there is a possibility to ease interest rates in 2024, that is when, since bond market works on forward pricing, that is when the bond yield started to come down, as we saw in the previous slide. And in fact, both on the equity market, the bond market, on the credit spread side, the financial conditions have relaxed. And as we can see, they are one of the easiest that they have been in the last 6 months. And that is also the reason that we are seeing pickup in growth indicators. And hence, if you look at the combination, which is you have easy financial conditions, basically means there is not a very strong argument for rate cuts. You have a very reasonably resilient growth indicators as well, and you have a persistent inflation. So that broadly, the combination of this broadly right now indicates that possibly we are looking at a shallow rate cut cycle rather than a very deep rate cut cycle, even amongst the advanced economies. Moving on to domestic trends. So the most keenly awaited event in April was the RBI monetary policy. Largely, it was in continuation of the February policy, and it was in line with market expectations. If you would recall, during the February policy, a large section of the bond market were expecting RBI to change stance or at least show concerns on liquidity, and they probably wanted a comfort on liquidity front. It was also in line with the global theme, as we saw during the beginning of the year. The bond market was expecting about 150 basis of rate cut from the Federal Reserve. So given that in February overall global conditions were quite benign, at that point of time the market was slightly disappointed with the RBI policy. But given moving on to April, as commodity prices have moved up, as growth indicators are looking better, as the expectations from the Federal Reserve also had come down, market was not really expecting any meaningful change in the policy. So in fact, the MPC composition also remained the same. They voted 5:1 to keep the policy rate unchanged at 6.5, as well as the stance was retained as withdrawal of accommodation. The FY25 growth outlook was retained at 7%, and the FY24 growth outlook was adjusted to 7.6%. That was the second advanced estimate given by the NSO. It's not really RBI's assessment, but NSO's assessment. I think the key takeaway from the RBI policy from the market was, one, on liquidity. RBI continued to reiterate that they will intervene in the liquidity market through VRR and VRRs to keep liquidity even, to keep overnight rates close to the policy rate, which is 6.5, which they have been doing for the last 3 months. So they continue to reiterate their commitment to reasonable liquidity. More importantly, on inflation and on future rate outlook, they retained their CPI inflation projection as same as 4.5%, although with a slightly downward bias. If you can see the table compared to February 2024 to April 2024, they have revised 1Q inflation projections from 5% to 4.9, Q2 from 4% to 3.8, and even the fourth quarter of FY25 from 4.7 to 4.5. So broadly, given that they are expecting slightly lower moderate core inflation, they do expect inflation to remain well behaved. What is concerning RBI is uncertainty on food inflation, given that we had a very weak monsoon last year, given that even the reservoir levels are running quite lower compared to last 10 years average, and even compared to the last year, RBI is rightfully concerned on any meaningful food price shock, and hence They want to be data dependent. They want to be confident that inflation is indeed getting close to their target before they think on stance or they think of any easing. As far as our view is concerned, our view has been that probably this cycle will be shallow. We are looking at 50 to 75 basis rate cut once RBI gets more confident on their inflation projection. That view still remains that once probably the RBI sees through the monsoon and is more confident that there is no spillover impact of any food price shock to inflation and to inflation expectations, probably it will be in a better position to take a call on interest rates. In the next 3 to 4 months, we will also get a sense on how global inflation is coming along. And so both from a global as well as from a domestic perspective, RBI will get a better understanding of how they can go ahead with the monetary policy. If you look at the domestic inflation rates, as we can see, the core inflation, which is depicted by the red line, it continues to trend downwards. In fact, it is the lowest ever in this CPI series. So from core inflation standpoint, things are looking quite comfortable. And this is not just a standalone indicator. Even if you look at current account deficit, lower imports also are indicating that probably underlying demand conditions, especially from consumption side, are not very strong. And hence, core inflation could remain moderate in the near term as well. So most of the inflation is coming from, very limited percentage of constituents which are high, in 2022, 2023. Now we are just looking at 30%. So it's just the 30% of inflation components which are kind of spiking the inflation number, and hence probably once we have better moderation in those levels as well, probably RBI will be in a better position. So like we said, that if you look at global food prices, despite all the geopolitical shocks, they are looking quite stable right now. Once probably this June, July period where we will have a better sense of the distribution of monsoon and the reaction on food prices, we'll get better sense on how inflation trajectory is likely to pan out. If you look at credit and deposit growth, if we see from 2023 end onwards, the deposit growth has picked up and is almost around 12%. Whereas if you look at the credit growth, it has started to come down. This was expected as RBI had brought in some macroprudential regulations, especially on the unsecured lending side. So we were expecting non-food credit to marginally move down, and that's largely happening. And we believe it's a good automatic stabilizer for the economy as the highly risky unsecured lending stabilizes at more sustainable levels. If we look at liquidity, like Sonal mentioned in the beginning of the call, liquidity now has been quite comfortable. The blip that we saw, the end of the March is typical seasonal issue that happens at the financial year end. But largely, if we see the spread between MIBOR and overnight rate, it has been quite well behaved. It has been around 6.5% for most part of the fourth quarter FY24. If we look at the fiscal trend, fiscally, things are quite comfortable. If you look at direct tax collections, both on the corporate and income tax side, they have maintained healthy growth. If you look at from YOY perspective, or if you compare it for the April to Feb FITD, even compared to the last year, same time, things are looking quite healthy. If you look at net tax revenue, it was about 80% of FY24 revised estimate, which is about 7% higher than FY23 YTD, despite the center releasing 2 additional installments of tax devolution to states. If you look at capex growth as well, that has rebounded, and in fact, it was higher by 300%, and it's tracking about 36% FITD YOY compared to 26.5%. So both on the expenditure as well as collection side, trends look quite healthy. We also had the borrowing calendar announced for central government bonds, for the first half of FY25. And as we can see from the left-hand side of the slide, it was a welcome change. So typically, government has been borrowing about 58 to 60% of total borrowing in the H1. But this time, they decided to borrow about 53%, which is about 7.5 lakh crores gross borrowing of a total borrowing announced of 14.1 for the whole fiscal year. So, and even if you look at the composition of the borrowing on the right-hand side, the government has starkly increased the issuance on the 30-year plus segment. So if you look at, on the 0 to 5 or 5 to 9 year segment, that issuance has come down and it has been gradually increased on the long end. And if you look at the weighted average maturity of issuances, it's planned about 20.8 years compared to 17.9 years for H1 FY24. So this is, we believe, is quite positive and constructive for short to moderate end of the yield curve, which is broadly about 5 to 7 years, yield curve, because the issuance there is slowing down. Liquidity is quite positive. Yields are likely to be stable, and hence this bodes well for steepening of the yield curve. So probably we will see short end outperforming the long end in the first half, which will be quite in contrast to what we saw during the last year, where the long end outperformed the short end because of lower supply of government bonds. Moving on, if you look at the state government borrowing update, even on the for FY25, government announced a borrowing of about 2.54 lakh crores. And if you look at how where the calendar is stacking up, it's broadly compared to Q1 of FY24, where the borrowing announcement was about 2 lakh crores, but the actual was about 1.7 lakh crores. So we do expect that probably the whole borrowing which has been announced, which is 2.54 lakh crores, may not be fully carried out and probably will still be slightly lower. But if you look at the previous trends and on the left-hand side of the slide, typically the Q1 borrowing is between 20 to 25% of total borrowing, even on the announcement side. So if we expect the same run rate to go through, we still may end up with a 10 lakh crores kind of a gross borrowing for FY25 as well, which will be quite high and again supports a steepening bias of the yield curve, because ultimately, if you look at the long end of the government bond curve and state government bonds, it's typically the same investors such as insurance companies, provident funds, pension funds, etc. And that's where the supply of the paper is increasing, and hence we do expect the short to moderate duration end of the yield curve to perform relatively better, given that we are expecting a shallow rate cut cycle. If you look at the gross treasury bill issuances, that's also come down quite drastically compared to Q1 FY24. The T-bill issuance in Q1 FY24 was about 4.16 lakh crores, and the actual was about 4.96 lakh crores. In Q4 FY24, which was the previous quarter, the issuance was about 4 lakh crores, and the actual was 4.3 lakh crores. If you look at the current, announcement, it's just 3.2 lakh crores. And if you look at the maximum, cut down in the segment, it is in the 182 days. So compared to the typical 1.5, 1.6 lakh crores, the planned issuance there has been just 80,000 crores. So again, within the segment, it bodes quite well for the 6 to 8 months of the yield curve for T-bills, in the upcoming quarters. We will need to see whether there is a change in the composition depending on the demand supply. But for right now, it looks quite positive for the 6 months of the yield curve. If you look at the trade numbers, we also had the release of current account numbers, as we can see for FY24, the trend has been very healthy. So if you look at Q3 FY24, despite imports increasing on higher oil as well as gold prices, if we look at the trend on non-oil, non-gold, and this is what we were talking about when we were talking about moderating consumption, they have largely been quite flat if we compare to the usual trend rate that we see in the Q3 of the fiscal year. And one of the positive aspects of the current account numbers, if we can see, is on the services side, numbers continue to be quite healthy. From a 40 billion run rate on the trade, now it's gone to 45 billion. So we are clocking in very strong service exports as well. So with higher service exports as well as remittances, as oil prices continue to be high, we are looking at a very manageable current account. So as we can see, from an annualized run rate between 2 to 3%, the current account run rate has become around 1.5%, especially next year when we have the bond index inclusion, and we are expecting about $20-25 billion of inflows on the bond side. Next year BOP number also looks to be quite comfortable. And if we juxtapose that with the foreign exchange reserves, which are almost at record high of 640 billion, which imply an import cover of 11 months, the FX situation, the currency situation looks to be quite healthy for India. And if we see the last 6 months, INR has been one of the least volatile emerging market currency, despite so much of dollar volatility. So from currency as well as from an inflationary standpoint, things look quite healthy for Indian bond market for FY25. So this is on the sovereign yield curve. For better depiction, as we can see on the 1 year and on the 3 year side, yields have fallen down. If you look at the 1 year AAA rates, they have gone from 789 to 785, if double A as well going down, and the 3 year also continues to be trending downwards across the curve. And I think from a forward-looking basis, given the demand supply and given that there is a certain uncertain outlook on inflation, probably bonds are likely to be driven by terminal rates rather than worrying about the timing of first rate cuts or the timing of the change in stance. We are still I discussed, we are still expecting a 50 to 75 basis rate cuts in FY25, with inflation expected to remain in a declining trajectory and averaging around 4.5% approximately for FY25. So if you look at the real yields perspective today, a 3 year bond or a 4 year bond is trading anywhere between 770 to 780. And if you compare it with the expected inflation of 4.5%, the real yield of about almost 300 basis points is quite attractive, which is presenting us good opportunity for patient investors to experience the high accrual. Mind you, given that there is an uncertain outlook on inflation, the rate cut expectations on timing can change. So hence, we are recommending investors to stay invested more in moderate duration products where the trade is not really dependent on rate cuts, but they can enjoy the accrual and they can also benefit somewhat in capital gains once the rate cycle turns. If we look at from a investment horizon of 6 to 12 months, the gap between the overnight and the 1 year space or the 6 months space has opened up quite a lot. So today the overnight rates are around 6.5, and if you look at the 6 months to 1 year part of the curve, it's somewhere around 747.5. So given the 100 basis strong accrual difference, we are recommending investors to consider low duration and money market strategy, and investors who are more tolerant of mark-to-market volatility and they have a 12 months investment horizon can consider allocation towards moderate duration, which is the 1 2 year, 4 year duration category, such as short-term bond fund, corporate bond fund, and banking and PSU debt fund. Typically, investors tend to allocate to long duration categories whenever there's a view of rate cuts. But however, this rate cut cycle is slightly different. This rate cut cycle is probably a more of a shallow rate cut cycle, and hence it needs to be looked at with higher nuance. It needs to be looked looked at what's the right risk reward on our allocation, and probably the right risk reward lies in the moderate duration of the yield curve. That is where I would like to end my you know session. Happy to take up any questions that all of you may have, and I would request Sonal to take them up. Thank you.
Thank you, Anurag, for your insightful presentation and outlook on the fixed income market. The webinar is now open for question and answers, and I invite the participants to share the questions in the link provided and make this session as engaging and informative as possible. While I wait for the questions to queue up, let me begin with the questions that we have already received. So first question goes like this, Anurag. Monetary policy continues to be actively disinflationary to ensure anchoring of inflation expectations and fuller transmission. The RBI continues to stress the rate hike transmission in bank lending and deposit rates. So what are your thoughts here on will RBI continue to keep liquidity in deficit for the full transmission to happen?
That question, I think liquidity is already in surplus now. So RBI has, like mentioned in the February policy, when market participants were raising concern on liquidity, that tight liquidity was largely due to government cash balances building up, because as the tax collection, which is the advanced tax collection, GST collection, etc., goes to the government balance and allocation, it comes back into the banking system and liquidity goes up. That's exactly what's happened really. Post February. So as the government release, as the spendity also has turned into surplus, and RBI is not really intervening there. So probably what RBI has been saying has been quite clear since, I would say, the last 1 year on liquidity, that they are not really trying to intervene very actively on liquidity. They are trying to ensure that liquidity is met for all the legitimate requirements. And if you look at the call rate in the last 2-3 months, since the government spending, it's been aligned close to the repo rate or around 6.5. So there could be couple of days in the whole month where liquidity becomes slightly volatile. But broadly, we don't think that RBI is anti-liquidity or RBI wants to keep liquidity in deficit. So we expect call rates to be stable, and that's why we are recommending investors to also consider money market and low duration strategies, because since we are expecting liquidity to be stable, and given that there's a 100 basis gap between the assets and overnight rate, we think investors can benefit from that high spread.
Sure, thanks, Anurag. The next question goes like, market participants missed any forward guidance in this current monetary policy. How do you read this? And in this slide, when do you see the rate cuts to start?
So like we said, I mean, given the uncertainty on food price shocks, it's very difficult for central banks to sound authoritative, especially on their rate outlook. And we think RBI did the right thing by not giving any strong forward guidance, because what really happens because of that, and what's really happened in last 2 years, and if you remember when some of the central banks came out with the forward guidance that probably inflation is transitory, and because of the COVID shocks, we found that inflation was much more persistent and durable, and it's still going persistent. So probably, given that their inflation outlook depends on how monsoon pans out, on how weather patterns pan out. In fact, RBI also mentioned about the recent IMD warning of above normal temperatures in the month of April to June. Although it may not affect cereal inflation, but it may affect your vegetable price inflation, which tends to be quite volatile. If you remember last year, it is because of tomato prices that we suddenly saw a jump in inflation between the months of July to September. So probably RBI is right and more sensible not to give any forward guidance. And I think we focus as investors and market participants a lot on the timing of rate cuts. What really matters for us is what are the amount of rate cuts that we are expecting in this rate cycle. What is our investment horizon? So for investment horizon is 6 to 12 months. We should not be taking tactical bets on interest rate cuts. We should probably sticking to our risk appetite and the kind of funds that make sense from a 6 to 12 months investment horizon, which are typically money market funds. If your investment horizon is more than 12 months, and we have tolerance for mark-to-market volatility. Anyways, the timing does not matter, because if we are investing from a 12 months investment horizon, and if there's an expectation that probably in this monetary policy cycle we are likely to see a 50 to 75 basis rate cuts, then anyways, given the long-term investment horizon, we don't think it should matter whether RBI does it in your 6th month of your investment or the 7th month of investment. And as we saw, in one of the slides of the Fed forward pricing, markets tend to price quite, in forward anticipation. And hence, the moment there is more certainty in the inflation outlook, probably our investors won't have to wait for the last rate cut by the RBI, to benefit from the capital gains. Probably once investors have a whiff of the rate cut cycle, the market can probably move along on those lines.
Sure, Anurag. So, on continuation with this question, our viewers would like to understand what is the likely outlook on the short-term rates, maybe less than a month. What is your view over there?
So in the near term, so while we don't usually advise for tactical opportunities, but from a near term, we do expect nothing materially has changed for the world in the last 1 month. Barring a geopolitical shock, which is slightly unmodelable, we really don't expect any major move in asset markets. We expect markets to remain largely in a narrow range, as they have been for the last 1 year for India.
Thank you for that. The next question goes like, India alone cannot do miracles based on its so far stable economy. How we view global GDP growth amid rising crude and gold, slowing China growth, high interest rate regime, and conflicts between the countries?
Right. So it's a very important question. I think if you look at the global growth outlook and try to understand the drivers, so it's true that China is a very large component of global growth, since 2000s. And of course, when Chinese growth goes down from 7% or 6% to 4.5% or 4%, it does affect global GDP growth as well. But we would say that probably if you look at the growth drivers, they are quite polarized, in the sense that, of course, India is growing well, but India still is a slightly smaller component of incremental global growth. If you look at the US, given that the way US economy is growing quite rapidly and quite strongly, in fact, US has been a major driver of global growth, given the strong, US consumer. And, probably it's, I would say, if you look at commodity prices also, so while there has been some volatility in commodity prices, but as we saw in our, commodity index chart, for almost 12 months, commodity prices have been quite stable. So yes, inflation has not been coming down to 2%, but largely commodity prices have been stable as supply chains are also improving. So while there are geopolitical tensions, the world has started to live with it. The world has started to adjust to it. So if you look at, when Russia-Ukraine escalation started in the month of, February, and compared to where we are in the last 12 months, supply chains have drastically altered. Things have become better. And even in China, apart from the real estate, from a growth perspective, if you look at auto sector and even the consumption spending, it's not as bad as it was feared probably 12 months back. So probably global growth is still chugging along at about 3 to 3.2%, largely driven by US and India. So we do expect this moderate growth pattern to continue, barring, like I said, a geopolitical shock, which is slightly unmodelable. But it, as long as the crisis also is contained, like it has been contained to a couple of regions for a while, we don't really expect any major escalation in commodity prices or global growth outlook for now.
Sure, thanks. Since we were discussing global market, my next question is for around the Fed policy. The Fed chair maintained a neutral tone in this policy, not reacting to higher than expected CPI print in January and February. The summary of the projections maintained 3 rate cuts for 2024 and revised up a core inflation estimate of 2.6% versus 2.4% earlier. Do you think the upward revision in inflation estimates and no change in the number of cuts projected this year indicates Fed's higher tolerance for the inflation? Also, in this context, what conditions will enable Fed to start cutting interest rates considering the new positive US job data?
Right. So I would just add one more point to the Fed outlook on the policy. Fed was not moderate. Fed was quite dovish, in fact, on the policy because they continued to ignore the last 2 inflation prints, which were higher than market expectations, and they assessed them as a bump on the road, and they said that inflation is largely going in the direction which they want. And I think I would not give too much credence to dot plots because, as we have seen in the last 2 years, those dot plots have kept evolving. But more importantly, the messaging from the Fed chair was quite consistent that right now, given the substantial fall in inflation from almost 9% in 2022 to where it is coming along right now, that gives them some policy space to cut interest rates. So I think probably, like the Federal Reserve has been saying, they probably need a couple of months readings to see whether inflation is indeed in that expected line to start initiating rate cuts, because they don't want a situation where they start with rate cuts, inflation starts to surprise on the upside, and they have to unwind all the rate cuts and in fact have to start rate hikes all over again. So they don't want to do that. So probably they want to wait for some couple of more points of data. I think NFP, if you look at from a Federal Reserve perspective, in fact, it's quite telling that despite such a strong job growth, the wage price pressures are really not there, which is indicating a better balanced labor market. So if you look at in the last 2 years post the COVID normalization, the labor demand has been quite high and the labor market has been quite tight. And if you look at the last 3-4 months, the labor market demand continues to be high, but the labor supply is also improving as US opens up on immigration, and which is really not putting any pressures on wage prices. So yes, we are seeing a period for now where labor market continues to be quite strong, yet it's not very inflationary, and in fact that gives additional comfort to the Federal Reserve.
In a year marked by inflation and economic challenges, interestingly, there has been a surge in the discretionary spending on consumer products by India's growing middle class. One of the driving factors behind this consumption uptick is the improved access to unsecured loans. RBI has expressed its concerns in the rising unsecured loans. Despite that, the growth of unsecured credit in the overall loan portfolio of Indian banks remained elevated, even after the RBI's decision to increase the risk weighting on the unsecured lending. Can you please share your views on this aspect?
So I think from a portfolio standpoint, we have been of the view that whenever there has been a very strong growth, in any asset class, typically when the business cycle reverses, some of the, institutions where the underwriting has been lax, And that is where we have to differentiate between the sector and some institutions where the underwriting has been slightly lax. Probably they may see more NPAs and some impact on the rating profile as well. And that is why it's important from an investment standpoint to stay invested with those financial institutions which have demonstrated strong corporate governance, which have a diversified business, which are not reliant just on unsecured business loans, which have other business segments as well. So when unsecured is not doing that well, they can move on to other business segments, and which are belong to strong, clean promoter groups. So I think that's where at UTI we have been focusing for a while now, that to stick to quality NBFCs, which have a demonstrated track record across business cycles.
Sure, Anurag. CAT to GDP remained steady at 1.2% in third quarter of FY24, with a widening good trade deficit offset by strong services and remittances flows. However, with increase in crude oil prices and risks emanating from the protracted geopolitical tensions, do you see any downside risk to the FY24 CAD estimate of 1% of GDP?
I think the year is largely gone. So for March, we really don't expect any major change for FY24. For FY25, I think if oil prices move meaningfully above 100 or beyond, that is when probably, I would say by between 10 to 20 basis points, depending on the crude demand at that point of time, things could get slightly I would say constrained, but largely at this point of time, as long as there is not a persistent shock to crude oil prices, we think CAD will continue to be quite manageable. The important thing is remittances as well as service exports continue to be quite well behaved. So as of now, we are not really assessing or foreseeing any major issues on the current account deficit.
Sure. You had discussed about government borrowing calendars during your initial remarks. The central government plans to borrow 53% of its FY25 budgeted estimated borrowings, which is lowest first half borrowing since FY19. Do you see the issuances calendar will be an added support for bond market sentiments along with index inclusion from June? Also, how do you see yield curve to shape up? Do you see there is a room for yield curve to steepen given favorable liquidity conditions and higher supply at the far end of the curve?
So if you look at long-term trends on the bond market, we don't think that a 5% change in the borrowing breakup may result in a meaningful change in trajectory of bond yields. While there is an announcement impact of such aspects, but typically over a medium term, bond yields ultimately take their cues from liquidity and forward inflation expectations, forward rate expectations. So I think going ahead as well, so while the market has taken the announcement quite positively, but from a medium term perspective, it's these aspects which will really drive bond yields going ahead as well. And if you look at largely the expectations on these fronts, we are all waiting for how monsoon pans out, because that can swing inflation materially. So in case the monsoon is very negative and inflation turns on the upside, then probably bond yields can correct irrespective of the supply, and because the rate expectations then change quite drastically. If you look at global bond yields as well, so in case globally the theme of some rate cuts in 2024 changes for any reason, then probably irrespective of the again supply or flows, things can change. And third, and more importantly, I think the FPI flows also would somewhat get correlated with global bond sentiment as well. In case the sentiment is quite weak, probably in the near term, flows could get impacted irrespective of the bond index inclusion. And hence, we are recommending that from a risk reward perspective, one should just not look one only at the long end. One can consider the short to medium end as well, which is not really dependent on rate cuts, which is largely dependent on your overnight rates, and they are stable. These are largely tactical calls. Investors who are looking fixed income as an asset allocation, we don't think should worry about or bothered about these numbers, whether it's 53 or 60%. It doesn't change bond yields in the long term.
Sure. Considering the time constraint, I will take two more questions.
Sure.
SDL indicated issuances for Q1 FY25 is higher at 2.5 trillion versus indicated Q1 for FY24 issuances at 2 trillion.
Right.
This you mentioned during your remarks also. Do you believe SDL issuances will remain elevated for this FY25? And also, what are your views on the SDL and GC spread considering all these numbers?
And so, if you look at the last year trend, and states' financials come with a certain lag. But if you look at the fiscal deficits of top 15 to top 20 states, they are somewhere averaging around 3% of GSDP, 3 to 3.2% of GSDP. We are also expecting a similar run rate this year, barring any major economic shock. And hence, we expect the gross borrowing for SDL for this fiscal year also to be similar to FY24, which is close to about 10 lakh crores. In the first quarter, typically SDL to GSEC spreads are slightly narrower because there are flows from long-term investors, whereas states tend to borrow less in the first quarter. However, we also have to see that probably the cash balances of states were lower in this fiscal year to start with. So probably some of the borrowing which would have come in the Q2 would have shifted to Q1. But I think from a steady state perspective, from the financial year perspective, we are still expecting a gross borrowing of about 10 lakh crores or slightly higher. And that may mean that one, the long end yields, which is the 30-40 year government bond yields, could get steeper compared to the 10-year. Even the SDL bond yields, probably in the second half of the fiscal year, could get slightly wider compared to the 10-year.
Thanks, Anurag. With this, we have reached the last question for today's webinar. Our viewers would like to understand how do you maneuver trade-off between yields and credit quality in our fixed income funds portfolio?
Thanks, Sunil, for that. So there is no trade-off between yield and credit quality. The credit quality is paramount. As far as how we assess credit quality when it comes to our funds, so every fund as defined by our GIMS framework, which defines the maximum amount of credit that every scheme can take in every issuer, defined by the rating matrix that every scheme can take. So whenever our credit team is assessing any credit to onboard in our investment universe, they look at it independently. They don't look at yield. They just look at the merit of the credit. Once that credit is added in the investment universe, the fund manager, as constrained by or as regulated by our internal GIMS framework, then looks at the risk reward of the particular credit, whether that is giving indeed the best risk return. So, for example, a GSEC at a certain yield could be giving a better risk return than a corporate bond, even 100 basis higher than GSEC of similar maturity because of the risk. So I think it's just we look at the various scenarios and what kind of risk that we are taking and what are the kind of returns that we are getting for that particular trade. But more importantly, when we onboard a credit in our investment universe, yield is not considered by our credit team, and just from a risk perspective, they are looked at independently.
Thank you, Anurag. On behalf of UTI Mutual Fund, I convey our sincere thanks to all the participants for participating in today's webinar. We hope you all found today's session insightful and engaging, and we also hope that your queries have been answered to your satisfaction. If we have not been able to take up some of your questions, please do write to us and we will try to respond to them. Please do share your feedback on the link provided to you. Special thanks to our speaker, Mr. Anurag Mittal, for sharing valuable insights. We look forward to connecting with you in our next webinar on equities, fixed income, equities market insights, which is scheduled on 10th of April. With this, we conclude today's webinar. Thank you and good day.
Thank you, everyone. Thanks, Sonal.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.